Hello and welcome to this week's webcast. Next week the Fed will announce gradual tapering of its bloated balance sheet. Far more important for investors, however, is what the Fed says about future interest rates. The first concern is a possible rate hike in December. So far, 12 of the 16 FOMC members have thought that a rate hike was on the cards before year-end. If this majority still exists next week, the markets will factor in a December rate hike. At present, the market only sees just under a 40% probability of this happening. But the Fed will also say something about rate hikes next year. So far, a majority of FOMC members have hinted at 3 moves in 2018, and this is also our prediction. The Fed may drop 1 rate hike from its forecast. However, we still see that the markets are factoring in far too little with just 1 potential rate hike before the end of next year. For one thing, the economy is doing well. Growth of 2% seems likely for the year as a whole. There is strong employment growth, reaching almost full employment. Second, consumer prices excluding energy and food rose more strongly in August compared to July. Inflation appears to be moving slowly towards the desired 2%. And finally, FOMC members have for some time been focusing more on easy financing conditions. Given the country's sound economy, these are no longer necessary. All in all, the Fed can be expected to raise rates more than the market currently forecasts. When this becomes clearer towards the end of the year, the dollar should pick up again. We predict a lower rather than a higher euro-dollar exchange rate in mid-2018. Thank you for listening. Please enjoy reading our Week in Focus.